Good morning and good evening, everyone. Nice to see so many people joining one by one, and welcome to the 2022 Australasian Aid Conference Speaker Series. My name is Anthea Molokala, and I am one of the conveners of this annual conference. I'm from the Asia Foundation, and I'm also joined by Stephen Howes and the development policy team at ANU. This is the second event in our alternative conference format from the usual in-person conference that we host every year at the ANU Development Policy Center. The Asia Foundation and the Development Policy Center have been convening the conference for almost a decade together. And while we all miss the dynamics of the on-site conference, and we look forward to reconvening in 2023. In the meantime, we're really delighted to have several of our alumni keynote speakers return to revisit their previous presentations and provide new insights. We're running this series monthly for 6 months this year. Last month, we were honored to have Eunmi Kim, president of Awa University in Korea, as our inaugural speaker. And next month, we have Donald Kabaruka, who is co-chair of the United Nations Secretary General's high-level panel on international displacement. And he'll be speaking on rethinking global health security. I hope you'll all join us for those. We are also delighted to be following the keynote addresses with blogs by the presenters. And though the first one will come out probably in a couple of days, perhaps early next week, and that'll recap the key arguments from Eunmi Kim's presentation. So we have it available in many formats. We're also recording, so you can watch these things at a later time. I'm especially excited to hear from our speaker today. Masood Ahmed was a keynote in 2019 at ANU, and he presented to a full overflowing house at the Crawford School. Sustainability is both a critical and highly sensational issue these days. Before we get going, a few housekeeping details for everyone. We have 1 hour. Please keep yourself muted, but you are free and welcome to keep your cameras on. We're in meeting format, as you can see. Please post your questions to the chat box. You're also welcome to raise your hand through the reactions function in the navigation bar. Feel free to post your questions throughout the presentation. It's always good for us to have a few questions ready to go when we start the Q&A session. And also, please keep your questions short, and we'd appreciate it if you could type in your name and your organizational affiliation. We are recording and we're streaming live on Facebook, so welcome to those of you joining on social media. I'd now like to pass to Sophia Shakil, our moderator for today's session. Sophia is director of our economic programs at the Asia Foundation, and she was previously our country representative in Pakistan. Most recently, she has led the foundation's empirical research on the economic impact of the pandemic on MSMEs in the region. Sophia, before joining the Asia Foundation, had a long and distinguished career at the ADB, and I know she's excited to dig into debt issues with Masood today. Over to you, Sophia.
Thank you, Anthea, and good evening, good morning, everybody. It's really my pleasure to introduce to you today our keynote speaker, Masood Ahmed, President of the Center for Global Development. Masood Ahmed joined the center in January 2017, capping a 35-year career driving economic development policy initiatives relating to debt, aid effectiveness, trade, and global economic prospects at major international institutions, including the IMF, World Bank, and the Department for International Development. At the IMF, Mr. Ahmed served for 8 years as Director of Middle East and Central Asia Department, where he oversaw the fund's operations in 32 countries and managed relationships with key national and regional policymakers and stakeholders. Earlier, he also served as the fund's Director of External Relations and Deputy Director of the Policy Development and Review Department. Before that, from 2003 to 2006, Mr. Ahmed served as Director General of Policy and International at the UK's government's Department for International Development, DFID, where he was responsible for advising UK ministers on development issues and overseeing the UK's relationship with international development institutions such as the World Bank. He also worked at the World Bank previously in various managerial and economist positions, rising to the rank of vice president, poverty reduction, and economic management. In that role, he led the heavily indebted Poor Countries Debt Relief Initiative, which has to date brought relief from debt burdens to many of the world's poorest nations. Mr. Ahmed is a UK national, but originally from Pakistan, moved to London in 1971 to study at the London School of Economics, where he obtained his bachelor's honors as well as MSc in economics with distinction. And it is our pleasure today to have him speak to us on debt management. So over to you, Mr. Ahmed.
Well, thank you very much. Thank you very much, Sophia. Thank you, Anthea. Thank you to everybody who's joined and those who are watching on stream. And I should say, Sophia, that we just discovered that we have, at least in common, that we were both also at LSE at very different times, I should say. But we have both had the opportunity to be there. So I want to talk a little bit about debt. And as Anthea said, 3 years ago, I had the privilege of being with you in person talking about debt. And I remember ending that particular session by saying that this wasn't going away. We would probably come back and talk about it again. And so here we are. My colleague, Erin Norton, has kindly agreed to join, and Erin will help me with making sure that we move the slides along. I have a small presentation that I want to use to guide our conversation. And so if we move to the next slide, what I really want to say is, debt really has always been there, but if you follow the economic and development discussions, you'll notice that over the last few months, discussions of debt have really picked up. If you look at what's coming out of the international financial institutions, most recently, the World Bank had just produced its World Development Report. There's big discussion of debt in that. If you look at the financial press, people are talking more and more about there being levels of debt in developing countries, poor countries, low-income countries, but also emerging markets. And they're talking about the risk of a debt crisis. And actually, even just before I came on to this session, I checked my emails. Even today, there is a new blog from the World Bank's, one of the vice presidents of the World Bank, talking about the impending risk of debt crisis. So it's very much on the agenda again. So the question is why? Why is debt back on the agenda? And if you look at the next slide, you'll see that one of the reasons is that over the past 2 years, debt levels have just grown. They've grown in every country. They've grown in rich countries, they've grown in middle-income countries, and they've grown in low-income countries. And it's not surprising because we've gone through the worst pandemic in 3 generations, the worst economic crisis, and every country tried to respond to that crisis by drawing on its reserves to spend more or to finance that spending from borrowing where they could. And I'm sure you've all followed the numbers, but rich countries were able to spend about 20% of GDP. Emerging markets were much less, about 6%. And if you look at low-income countries, about half that. Why? Of course, they were constrained in what they could spend, but even so, in every country, you've seen an increase in the debt levels. So people are beginning to worry for the simple objective reason that debt levels have grown. And in fact, if you look at the debt burden of low-income countries, in 2020, it went up by 12% during the course of that year to 860 billion by the end of that year. And of course, as that goes up, debt repayments start going up and will go up even more. Now, if you look at the next slide, you say, well, what does that mean for debt levels have gone up, but how much should we be worried about? And if you look at low-income countries in particular, let's talk about them first. So this is a chart that the World Bank and the IMF produce in different ways. They take all low-income countries and they group them in terms of their risk of debt distress. And what does that mean? It's simply looking at how likely is it that they're likely to run into some kind of debt problem in terms of servicing their debt, in terms of managing it. And they do this by doing what they call debt sustainability analyses for each country. And then they look at the universe of these countries and then they say, well, are they at a low risk of debt distress? Does that mean, they're all right, they don't really need to worry about debt? Is there a moderate risk, or is there a high risk of debt distress? And then there are some that are already in debt distress. In other words, they already can't manage to meet their commitments. And the red part of these bars are the countries, the share of countries that are in at high risk of debt distress. And obviously what you can see is that half the countries are now at high risk of debt distress. And that's higher than has been the case over the last decade. So every year, first of all, with the first part of the decade, commodity prices were doing well. There was an improvement in the profile. There's been a sort of steady worsening. When we talked in 2019, it was already beginning to be evident. And at that time, we had 2018 numbers. And now you see it's already much worse. And in fact, I know that one of the regions that many people on this call will be particularly interested in is in the Pacific. And if you look at the Pacific, for example, 7 of the small island states in the Pacific are included in that group of high risk of debt distress. So just to be aware. So that's mainly low-income countries, but if you look at emerging markets, countries that have market access, in the next slide, that's a chart that which shows a list of countries. This is a chart that came out recently in Bloomberg. This is a list of countries who are currently, whose debt is trading at least 1,000 basis points over US Treasuries. So they're paying on their commercial debt, these are people who have commercial access, 10% trading, that's the sort of market options derived value of their. And as you can see, that some of these countries already having, Lebanon obviously already unable to service their debt, but there are also a few others that fall in that category. So bottom line, debt profile objectively has been worsening over the past 2 years, and that's one of the reasons why people are beginning to talk more about the debt problem than they were a year ago. And if you look at the next chart, what you'll see also is that if you look at 2020, this is the chart on the left-hand side. What you have is how many times did the rating agencies do a rating action that was downgrading debt, and how many times were they actually saying that prospects have improved for emerging markets. So everything above the line is improvement, everything below the line is a downgrade. And what you can see in 2020, many more downgrades than there were actions to say that prospects have improved. Again, not surprising. During the pandemic, rating agencies were looking at countries' prospects, debt numbers going up. So the market's getting a little bit worried. On the right-hand side, what you have is looking at the spreads that people have been paying. I was just showing you in the previous chart the 10 or so countries that were paying very high spreads. If you look across the board at emerging markets and then at low-income countries, the blue is the range of spreads they were paying at the beginning of 2020, so just as the pandemic was starting, and the red is the spreads, the range of spreads in the middle of 2021. So you can see that the range of spreads was widening and getting higher. So the cost of borrowing was rising for everybody, and downgrades were increasing. Okay, so let's move to the next slide. Beginning of this year, this is a slide that just shows every January over the last decade, what has been the new issues that people have come to the market with. And what this shows is that this January 2022 has been the slowest start for new financing from the markets. So people are getting worried about debt because the numbers are rising, because the markets are sending signals in various ways through rating agencies' actions, through spreads, and through the volume of money made available, saying, look, things are getting worse. All right, so let's move to the next slide. So what has been then the response to this over the last 2 years, to this growing debt problem? Let's talk a little bit about that. Well, I would say the basic response has been buying time. The international community's basic response to debt has been to buy time. And the main way that it's done that is by having what was called the DSSI. People like acronyms and this. It's G20 got together and essentially agreed for a group of mostly low-income countries that they would put a standstill on the official debt service that was coming due from them. First, it was going to go through the end of 2020, then it got pushed to the end of 2021, and it provided about altogether, I believe, $12 billion of short-term help in terms of allowing them to push off to later the repayment of this $12 billion. But just remember, it's just pushing it off until later. It's just postponing that problem. It's not as if that problem's gone away. And the other thing was to say, well, let's put in new money. And the IFIs, the IMF, the World Bank, other IFIs all ramped up their financing compared to their historical levels. So they provided substantially more financing. And financial markets, as I said, were pretty open in 2020, so people could go out, at least some emerging markets could go out and borrow money from them. As we just discussed, all that's beginning to change now. Markets getting a little less open, but financial markets were open. And a very big number was the allocation of SDRs. Now, many of you are probably familiar with SDRs. If you're not, we can talk about it in the question and answer session. But essentially, this is providing $650 billion of reserves to the world through a special action taken in the auspices of the IMF. Most of this money goes to rich countries because the money is allocated in proportion to the shares, the quotas that the countries have in the IMF. So most of it, 2/3, goes to the rich countries. The remainder goes to the emerging markets and to low-income countries. Not a whole lot to low-income countries, 20 billion, 21 billion, compared to 650. And there are many schemes underway, and I'm very happy to talk about them if anybody's interested, on how some of the money that's gone to the rich countries could perhaps be reallocated, rechanneled for use in supporting the countries that need it the most. But the basic initial allocation during 2021 provided this amount of money, which was even 21 billion was not trivial for low-income countries. And as I say, for emerging markets, it provided a significant amount of liquidity. But on the debt front, as I say, mostly a process of postponing repayments through this standstill. Now, let's go to the next slide. So now we come to 2022. And as we approach 2022, everyone's saying, look, next year's going to be much worse, much harder. Why? Why is it going to be harder? So here's 5 reasons. I'll add one. The first is, if I'm sitting in Washington, here people are talking now, what comes after the pandemic? The pandemic is, in many people's minds, sort of, we're done with that. Now we're moving beyond that. We're talking about other issues. But if you're in Africa or if you're in South Asia, only 11% of your population has yet been vaccinated. So the pandemic is still very much a live issue for the next year for a lot of people, a lot of countries. And that divergence in the pace at which they're able to exit from this pandemic is going to be a source of a continued headwind for many low-income countries in 2022. Secondly, they're running out of fiscal headroom to deal with the pandemic, because you remember they all borrowed more, they spent what they could last year and the year before to respond to the pandemic. Well, most countries have now used up whatever space they had to borrow or to spend more from their own reserves. So in 2022, the problem's still there, the pandemic's still there, but they don't really have the capacity to carry on spending. As if you live in a rich country, we have a lot more capacity to draw down reserves, to borrow from the markets, but not if you're in a number of countries in Africa or in South Asia or the Pacific. Thirdly, the financial markets are tightening up. Inflation is now the biggest problem worry that everybody has. From not talking about any rate increases 3 months ago, now we're talking about how many times does the US Fed, how many times will the Fed have to increase rates this year, and by how much? And people are talking about multiple rate increases, and markets are beginning to tighten up. When rates go up, then private money starts to be much less looking for yields in emerging markets. And also the cost of any outstanding debt begins to go up. So general tightening of financial markets. Fourth, the SDRs, as I said, were a very big liquidity source last year, but okay, it's going to get used up. People have already put it to use. So there's no more SDRs coming now next year. And then finally, the DSSI, this debt service suspension initiative, which provided people with breathing space until the end of 2021, well, that initiative has now come to an end. So basically looking ahead, lots of reasons why things are going to get more difficult, and people begin to see, oh, this could really result in a lot of accidents on the debt front. I said I would add one, and that is, of course, we haven't worked through what will be the consequences of the current catastrophe, I would say, that is unfolding in Ukraine with the invasion of Ukraine by Russia. And how will that have an impact in terms of the prospects for developing countries in other parts of the world is something that has to be worked through. Okay, so as the problem of debt became larger and people saw that just postponing debt service wasn't going to be enough, a year ago, the G20 came up with a framework to deal with debt issues that went beyond just postponing the repayments due for the year. And that is in the next slide. Let's look at that, Aaron, which is, and they called it the common framework. Essentially, the common framework was a framework that was agreed by the G20, introduced a year and a bit ago, and its main purpose was to provide some common place where the creditors could all come to, official creditors could come together to agree on a way to deal with debt in countries that had gone through the DSSI. So it was only for those who were eligible under the previous debt service scheme. There's 50 or so countries that have taken advantage of it. And some of them clearly needed more than just postponing of debt service. So this was going to be the way to make that to happen. is essentially taking the old Paris Club model, which used to bring together official creditors, and extending it to bring the new creditors. And by new creditors, just fancy long words to say mainly China. China is the biggest creditor in many low-income countries today, and this was a way of bringing China into the process directly. And now, sort of a year later, for the first few months, everybody was very gung-ho on the common framework. This is going to be the way to move forward. We'll make progress. Now, a year later, everyone's a little bit, not quite working out as well as we thought. Why? Firstly, it's very slow. Only 3 countries have actually come forward and asked for support under it. Not a single one of them has actually been able to complete the process, a year and a bit. And more calls that this isn't working. Now, initially, it was people in civil society who were saying this isn't working, we need to make it work better, faster. Then you start seeing that people like David Malpass, president of the World Bank, and Kristalina Georgieva, who's the managing director of the IMF, and their senior colleagues are all writing blogs saying the common framework isn't working, we need to do better. So now today, if you like, the sort of general accepted view is common framework is still the best framework we've got, but we've really got to make it work better. Now, if you look at the next slide, the basic problem, as I said, is common framework is a way of bringing China into the process. This slide on the left really shows the different creditor groups who hold debt in low-income countries. And the dark blue is China. Now, you don't need to go through all the details of the other slides, and I'll make sure that the slides are available to anybody who wants them. But bottom line is, China has become the largest creditor, single creditor. And in fact, if you look at debt service payments, of the 35 billion that the 74 lowest income countries owe in debt service this year, about over a third is going to go to Chinese creditors. About the same amount to private creditors. And the Paris Club is only, about 60% of what is owed to China. And that's all the countries of the Paris Club together. So China has really become a big part of the development financing. And that's a great thing, actually, for many developing countries, because this is how they've been able to do their investments and their projects. So, the question becomes, can we find a way where in the countries that need debt restructuring or debt treatment, reprofiling, you can get China to be part of a multilateral framework rather than to deal with it bilaterally. Now, I know we're running a little bit slow, so I'm going to move quickly through the remaining couple of slides. And so the question becomes, okay, everybody wants to improve the common framework. How should we improve it? What needs to be done? And it's fairly, now everybody's saying more or less the same set of things. One set is about, let's make it more attractive for countries to ask for support. At the moment, if you're a country and you have some debt problems and you say, shall I go to the common framework and ask for help? Well, you don't know what you're going to get from it. How long will it take? What will be the process? In the meantime, your rating is going to go down. You'll have more difficulty borrowing money. Some of your creditors will become unhappy. So part of it is, let's be clearer on the process. Can we also have a standstill so that once you apply for help under the common framework, you don't have to keep paying those creditors during that period? That'll also be an incentive for the creditors to act faster. Second thing is to say, can we put a little bit of incentive? Incentive is another word for pressure on some of the creditors by getting the IMF to help countries if they're making good faith efforts to deal with their creditors, to still lend to them, even though they might be in arrears. Some people saying, well, do we need actually more than this case-by-case approach? Should we just have like a HIPC-like arrangement? I spent a lot of my early time in HIPC was one of the things I worked on, and at that time we did it as a sort of group and countries and try to find a sort of an approach that helped to deal with all of them. At the moment, the creditors don't seem to be ready to go beyond a country-by-country approach to look at the group. And then finally, some are saying, well, shouldn't we go beyond the countries that are covered by the DSSI, which are mostly low-income countries? Because, as I said earlier, some emerging markets are having problems. Shouldn't the emerging markets also be able to ask for support under the common framework? So people have come up with a set of proposals. The IMF and the World Bank heads have proposed a few things to the G20, and we're now waiting to see what happens next in terms of improving it. And let me just end by saying one other slide, which is essentially to say that beyond the common framework, this is all about fixing the problem of the debt that is unsustainable now. There are also a lot of ideas, G30, the World Bank's WDR, the Bretton Woods Committee, there's a roundtable organized by the FAS and CBI, all have come up with various proposals on how to make sure that in future, the architecture for sovereign borrowing is improved so that we don't keep having these problems with debt. So, up to everything I've been talking about so far has been about fixing a problem that is already here. But why can't we do things that will actually reduce the problem of the likelihood of problems in the future? And they're mostly around transparency. Some of it is to improve the incentives for people to be transparent. You can go further and actually require transparency. You can link new funding to transparency. You could have regulations. Some people are saying, why not have laws that say if your debt is not transparent, you can't enforce it. If you have a hidden debt, you remember the problem with Mozambique where they discovered all this debt that nobody knew about. Say, well, I'm sorry, if you don't know about this debt, you didn't record it, it's not enforceable. Many ideas on the table that would improve the framework for debt going forward. Some of them more voluntary, some of them more assertive and saying we need to actually force people to be transparent, and some saying also that we need to be prepared for the fact that when countries go through a debt reprofiling, they lose access to markets for a while. And the official agencies need to provide them with the financing during that period to help them do that. Now, so not a shortage of good ideas. Some not so good, but a lot of good ideas are on the table. The real question, this is my last slide I put up now for you to think about, is after this one, is who is going to take this agenda forward? So it's not a shortage of analysis, it's not a shortage of ideas, but at the moment, who is the owner of the common framework? Who's there saying, I'm going to make these improvements happen? As I said, everybody is offering suggestions on how to make it better. I have my list of suggestions. I'm sure you have your list of suggestions. But at the end of the day, the G20 is a collection of countries. They have to agree. And if some of them don't agree, then it's hard to get consensus to move forward. The Paris Club has been very active in the past in this space, but now with China being the largest creditor, can't be the Paris Club by itself. China has actually been very proactive in dealing with debt problems that have come up with regard to its lending, and has provided more debt relief in the DSSI than any other country. But a lot of it has come through bilateral discussions between China and the borrower, not necessarily through the multilateral framework. So I think jury is still a little bit out about how much one can create that framework, how the G20 do it, and how much the IMF and the World Bank will be empowered to drive this process forward. So go beyond making suggestions. Who will drive the process to say, let's amend the framework for commercial lending? For example, if you were to say, let's have an agreement that commercial loans to countries, sovereign borrowing from commercial banks that is not transparent, not recorded, cannot be enforced. Now, who is going to drive that process forward? So I think the real thought that I want to leave with you is, will we need to have some debt-related accidents to motivate that process of change, or will we be able to make the changes that are needed to deal with the problems of the past before they turn into accidents? Because everybody agrees intellectually that the cost of cleaning up a debt crisis is much higher than the cost of acting to prevent it. If you have to take a haircut as a creditor before there is a debt crisis in a country, you're likely to suffer less than if you actually have to come in after a debt crisis when the country's growth is impacted, they're much lower. You will actually come out financially worse. So the evidence is all there. But the incentive, who's the commercial creditor that's going to go in and offer to take a haircut until they actually have to? So I think that is going to be the challenge going possible that we need to address going forward. So let me stop with that. And as I say, I'll be very happy to listen to your own take on it, and also to answer any questions if somebody has questions. Thank you.
Oh, thank you. Thank you, Mr. Ahmed. This was just, you know, a really great presentation. We have some questions that I think, you know, let's just try. I'm going to pose your way. From Anthony Swan, why are many debt-distressed countries turning to the IMF for support only at the 11th hour of a financial crisis? What can be done to enable the IMF to engage earlier before a country's debt becomes unsustainable?
Shall I answer the question one by one? What would you like? Let's do them short answers quickly.
Short answers, yes.
Yeah, so look, Anthony, I would say two things. One, if you are, most countries, when they have debt problems, it takes longer for them to build the support internally to take the difficult decisions that they will need to take if they address the debt problems, go to the IMF. And not just when you have a debt crisis, but many countries delay coming to the IMF for help when they have an economic or financial problem, because they know that coming to the IMF will be a moment of reckoning in a way, right? You have to then take the difficult actions of cutting your budgets, and sometimes you have to do, your exchange rate is overvalued. So you try to postpone. It's like visiting the dentist. You know, I only go when my tooth really, really hurts. And you know, I was in the IMF, right? I mean, so many years. And my plea to countries was, really, it's going to be worse if you got an infection in your tooth, you know, it's hurting. Come sooner, because if you take longer, we're going to have to dig a lot deeper to be able to deal with that problem that you've got there. But I think it is partly that. Partly also, I would say, in the case of the common framework, because the day I come to you, my rating agency probably will downgrade me. My cost of borrowing will go up. Some of my bilateral creditors will be unhappy. And I'm not sure what I get from it and for how long will it take. I look at the case of the other three countries, Zambia, Ethiopia, and Chad, and it's a year and they still haven't come out of this. So I think the more we can give incentives to countries and help them to come forward, but at the end of the day, countries drive their own destiny. So my plea to countries always is, don't postpone the inevitable. when you think things are just going to get better by waiting, more often than not, they get worse.
No, thank you. And I mean, like you said, like if you have a toothache, you don't wait, you come sooner. I mean, there's also some preventive measures that one can take to ensure that things don't get to that. Maybe you could shed a bit of light on that in a bit. But let me turn to a couple of questions that have been posed about China's approach to the debt it holds, and how is it possible to make the conditions attached to loans provided by China more transparent, and what if any incentives could be given to China to join the common framework, and is there any benefit from China's perspective for them to be part of this framework, and elaborate more on bringing China to the multilateral table.
I think this is a really important issue. It's a complex issue. I mean, look, many of you on this call are in Australia. You know very well these discussions have been happening in the context of also some of the lending by China in the region, in the Pacific. I think there is a distinction that has been made, which is China has done a lot in both financing and in dealing with countries on helping them when they run into problems with that finance. So we just have to recognize that. Maybe we need to recognize it a little bit more than sometimes we do. But there are also issues of transparency around a lot of the loans that come from Chinese financial institutions. Here at the Center for Global Development, my colleagues Scott and others did some work that actually looked at the terms and conditions of some of the loans that had been provided by Chinese financial institutions. And in many cases, the terms and conditions very similar to others, but in a number of cases also the terms and conditions had some fairly unusual features. But one feature that was quite unusual was a sort of an explicit prohibition not to share the terms and conditions. So there was a sort of a leaning towards lack of transparency. I think in the longer term, China is becoming more and more part of the global financial and monetary and development system. And as the largest creditor, in a way, it's in its interest from where I sit outside to actually be part of a system and help drive it. But it's also important for the other creditors to recognize that they can't simply ask China as the largest creditor to come and join a system that existed on the terms that existed before. It has to be sort of co-created, co-crafted with it. And I think this is just a sort of 2 steps forward, 1 step back process. And overlaying on this is the sort of growing tension, whatever you want to call it, rivalry between China and the US on a range of other fronts, makes it a bit harder to find common spaces. And I would say, look, no matter what your relationship is as a bilateral relationship, on some areas, it is in everybody's interest to act together. Climate change, dealing with pandemics, trying to find common solutions to debt. We can find a solution that is in everyone's interest if we try to work together. And I think that's what I hope people will be able to work towards.
Thank you. I mean, that's a really important point, and I think it moves us into a set of questions, one which I had and one that Tim Watkin has posed, which is looking at measures taken by countries that have just kind of run out of the fiscal space that you're talking about. And, we've heard that spending on basic essential services as well as on essential social protection measures is so critical at a time of the pandemic, but generally, in a situation where countries are dealing with spiraling inflation and whatnot. So do we have an up-to-date picture of the impacts of debt distress, as well as any analysis on measures taken by countries in high debt distress to protect And how can they protect these essential, expenditures on social protection, on essential services, including health?
Right. Again, very important issue, I would say, goes beyond debt. More generally, look, the recovery in low-income countries. I use the words, I paraphrase the words of the head of the IMF here to say, I think he used the term, it's going to be long, uneven, and faltering. So we're going to see, for many countries, this is a 5-year recovery. If you look at some of the studies that the World Bank has done, it shows that it'll be a decade before we get to the just recovering in terms of poverty level. Look at the kids that have lost 2 years of schooling, and so many of them are not going to come back. And even the ones that come back into school will take years to catch up because they have not been able to get the kind of remote schooling that so many people in Australia who are out of school. Your kids were out of school for a period. Here in the United States, kids were out of school for many semesters, but they were getting homeschooling in ways that are not feasible in low-income countries. So look at the consequences of the increase in health-related mortality outside of COVID during this period. So much was put on hold. Vaccine campaigns that were not for COVID have been put on hold. So I think for the next 5 years, it's going to be a very difficult period for many developing countries and low-income countries in particular. And during this period, social protection expenditures are going to be under pressure. Livelihood-related funding is going to be under pressure. And I would say also investment in human capital and education is going to be under pressure. And we're not even talking about the green recovery that we want to, into which we want to invest hundreds of billions of dollars. And at a time when, in fact, the financial flows are going to be tighter for a range of reasons. So I would say one of the worries that I have, it's getting a little bit beyond that, but let me say it, is that when we were all in the bottom in 2020, we'd all been hit by this pandemic. We all fell quickly to the bottom. And it was very bad then. People were dying around us and we knew there was no vaccine. But everybody was in it together. There's a little bit of comfort from knowing we're all in this and we're trying to find a way out. Sense of solidarity. And then a year later, vaccine comes along. Great, fastest vaccine delivery in the history of the world. We have never had a degree of vaccination of this scale in the world as fast as we did with COVID, right? But in the rich countries and in the middle income countries, low income countries, as I say, if you're living there on your social media, what you're seeing is everybody else is climbing out of the hole. You're still stuck there. And so you feel the pain of being stuck there even more because now you can see what is feasible outside and your sense of solidarity starts turning into a sense of resentment and disillusionment with the multilateral system. And you don't believe that people really care about the welfare of people in low-income countries in the same way. And I feel that the long-term consequence, the biggest long-term scar of the pandemic and the way we have failed to respond to it is going to be recovering that sense of trust and common purpose that we lost because of the inequity in the way in which we have responded to the recovery.
So true.
That's not about debt.
Yeah, but it's really important. I think there's a lot of linkages. But as we talk about recovery, what about, you spoke about green recovery and that countries are, committing to do so. What are the impacts of the global debt crisis on the adoption of sustainable debt instruments such as green bonds for developing countries? The question is being asked because Pacific Island countries are exploring these options to bridge their climate finance gap. So any insights on that?
Look, I think that green bonds are an instrument that markets are trying to develop. Everybody wants to see if this is a way. Actually, you could, in fact, even by linking it in some ways, you can do debt for environment-related swaps of various kinds. So you could see potential. I think we should celebrate them. We should encourage their development, but we should be realistic that the scale of we're seeing and likely to see in the next few years, this is not going to solve the overall financing problem that we are going to have to face. And what I sometimes get a little bit worried about and sometimes a little bit impatient is somebody comes along with an innovation of one, some kind or the other, and they're all, I mean, they're very nice, they're good, no problem with them, but don't think of it as solving a problem that it's not going to solve. Let's deal with the issue in the scale in which it's likely to contribute.
Thanks. We have a question from Jim Brumby at the World Bank. The debt transparency push seems to rely on statistical compilation of debt data rather than on debt and liability information that is consistent with international accounting standards. So would international accounting standards applied to the government sector help to deal with many of the transparency gaps?
I don't know the answer to that. So I mean, I think it's a good question. I'll go in, maybe talk to some of my colleagues. And of course, since the person who's asking this question, you said is from the World Bank, you guys are the experts on debt. And one of my earlier functions in the World Bank was actually to be in charge of what used to be in those days called the International Debt and Finance Division. So I'm hoping that those colleagues who are still there are busy working on it. But I would just say, look, the real problem with debt, with transparency, part of it is what are the norms, what are the standards, but part of it is the willingness. Are you willing to be transparent, and what are the incentives for both creditors and lenders to be transparent? And the flip side of that is, what is the cost of not being transparent? Today, there really isn't any cost to not being transparent. So until you fix the incentives, I think the actual metrics will only go so far.
No, thank you. And, and I think transparency plus what you spoke about earlier in your presentation about sincerity to not just kick the bucket down the way a bit, but to really address some of the, issues with everybody around the table, that becomes important rather than just pushing the problem into the future and then one's faced with it. So I think we have a couple of comments and observations relating to looking forward to hearing your thoughts on some of what are some of these measures that you tabled a little bit earlier going forward. And how do countries come around the table and manage the risks associated with becoming more transparent and holding things more, systems more accountable. Just your thoughts on that before we hand over to Stephen.
Well, look, I mean, I don't have a lot to say on it. The Bretton Woods committee report has a lot of discussion of agreement on the voluntary standards of disclosure and trying to get, in particular, getting the countries to agree on some common norms on disclosure. To my mind, it all comes down to getting the key players to agree that it is in their common interest to have that some level of disclosure. It's better to have imperfect disclosure by all than perfect disclosure by some. In a way, even if it's not perfect, if you start building towards that with a broad group of creditors and countries, I think that would be good. But these are collective action problems rather than technical problems. And I think that's the key issue is, can you build a climate of confidence in which the key shareholders of these institutions and the key players begin to come together to do it? We haven't talked much about private sector. The private sector really has not provided any debt relief of any consequence during this pandemic. And basically, when the common framework came out, I saw some notes circulating amongst people who sort of advise the private sector, basically saying, don't worry about it. This isn't going to change the rules that much. I think the question is, are governments, how far are governments willing to incentivize the private sector to also participate? Now, private sector has provided quite a lot of financing, but sometimes if you look at the terms of that financing and even the transparency of that financing, you wonder, how sustainable is it? When a country is borrowing at 7 or 8% in the market, you'd have to grow at a pretty good rate for a pretty long time, better than most of us have ever been able to see, let alone achieve, to be able to sustain significant borrowing at that rate. And so I think that's, to come back to your earlier question about the visiting, why don't people go to the IMF sooner? I would say if you're borrowing at 8% in the market, you really need to think about, is this the right path to be on?
Absolutely. No, thank you. And, debt restructuring is definitely needed to regain fiscal space for COVID recovery. We have one final, sort of comment and question, but then we'll bring it to a close. But how about, in this context, attainment of the Sustainable Development Goals and climate action objectives? I mean, debt restructuring is going to have to make fiscal space to address these challenges, which are so important. So any final thoughts? And with that, I also then just hand it over to Stephen to sort of bring this to a close.
I guess the only final thought I would say is, before I say hello and thank Stephen also, who, of course, the last time I saw in person was exactly at that conference 3 years ago. The only final thought I would have is, look, debt is going to be one of the issues that has to be tackled as part of the package of measures that will get us to the financing of our climate goals as well as the SDGs. But the SDG and climate financing agenda is a bigger agenda than the debt part alone. And I think there are equally important issues of how are we going to mobilize financing to achieve that, including how do we repurpose our development banks to make global public goods, climate, pandemic preparedness and prevention, part of their core mission, rather than as an add-on activity, particularly in middle-income countries. So I think there are many big questions that we have to address about financing them. And I think we need to do so with ambition, but also without self-delusion. And without sort of pretending that things will fix themselves or will happen when we don't see any evidence that they will. So with that, thank you very much. And over to you, Stephen. Great to see you.
All right. Well, thank you very much, Masood, for that, for your talk. And of course, I remember the talk you gave in 2019. It was on day 2 in the morning, and we had the packed Molonglo Theatre, and I remember that everyone was spellbound. And I think I could say the same again, actually. I mean, I was certainly spellbound listening to you this time, and I'm pretty sure everyone else was. I think it's that, the way you bring a lot of new facts, at least the facts that are new for a lot of us watching. Of course, the gravity of the issues, the sense that solutions are there, but may or may not be reached. And then, of course, your calm delivery that takes us through it all. So thank you very much. Thank you, everyone, for tuning in today. It's great to have such a good participation. And just looking at some of the names, I can see we've got people from around Australia, but also around the region, from several Pacific countries and further afield, and from many different walks of life, whether it's academia, government, consultants, NGOs. And I guess that's testimony both to your reputation, Masood, and also, again, the importance of the issue. I thought a number of the points you made, but especially that one about how we sort of lost our sense of solidarity, really go to the topic of our next talk in this series, and that's in April. So it's Tuesday, the 5th of April. It's a slightly different, well, it's at a very different time. It's at 7 p.m. to adjust to a London time schedule. But also, let me thank you, Masood. I think it's evening in your time, quite late evening. So thanks, especially for that, making time for us. But in Tuesday, 5th of April, it's Donald Kaberuka. And he is, former Rwanda finance minister, former president of the African Development Bank, now chair of the Global Fund. And he'll be talking about the lessons that we've learned and about rethinking global health security. So I think in a way, that's the other half of the broader theme that Masood was addressing today. So do tune in Tuesday, 5th of April. Of course, we'll be putting information about that shortly. But I will close proceedings now. Thank you once again, Masood. Thank you everyone for coming. And I think this is turning out to be a great series. Thank you, Sophia, for being our guest host and to our partners, the Asia Foundation. And look forward to seeing you all on Tuesday, the 5th of April. Thank you.
Thank you very much for inviting me, and look forward to being there in person at your next event.
Next year.
Thanks, Masood.
Thank you, Masood.
Bye.
Thank you,
everyone.
everybody. Thank you. Good night.